This morning changed everything. Silver didn't just fall, it collapsed $15 in 28 minutes flat, from $121 down to $106, a brutal 15% evisceration before most traders finished their coffee. But here's where it gets absolutely insane. As I'm recording this, silver just flipped positive for the entire day. You heard that correctly. After getting demolished by $15, it's now trading green at $118. This isn't a market anymore. This is a war zone, and the institutions are losing. January 29th, 2026, and the paper manipulation machine just broke in real time. The old rulebook burned to ashes this morning. I'm OG John AG, and I don't sell you anything. No courses, no signals, no premium groups begging for your money. What I do is connect dots that Wall Street desperately wants you to ignore. If you're finding value here, drop a comment with OG John AG so I know the real community is watching and the bots haven't taken over. Now let me walk you through what actually happened today, because the official narrative is pure fiction. At 9:15 a.m. Eastern, silver was trading peacefully at $121 per ounce, consolidating gains from an incredible run. Then, at 9:43 a.m., the selling began, not gradual, not organic, but a vertical cliff dive that triggered every stop loss from here to Shanghai. By 10:11 a.m., silver had cratered to $106, wiping out 2 weeks of gains in less time than it takes to shower. Trillions in paper profits evaporated as leveraged positions got liquidated automatically, margin calls decimating accounts across every futures exchange globally. This was textbook shock and awe, the kind of violent move designed to break the spirit of every bull in the market. But then something extraordinary happened that's never occurred in the entire history of precious metals trading. Instead of cascading into days or weeks of relentless selling like 2011, 2013, 2020, every other major crash, silver found a floor. By noon, it had clawed back to $112, and by 2 p.m., it crossed $115, and now at 4 p.m., we're sitting at $118, officially green on the day. Let me repeat this because it's critical. A $15 crash in 28 minutes, completely reversed in the same trading session. That has literally never happened before. Not in silver, not in gold, not in any commodity market with this kind of historical manipulation. The implications are staggering, and they point to one undeniable conclusion. Physical demand has become so overwhelming that paper suppression no longer works. Here's the data that Wall Street doesn't want you seeing. According to real-time feeds from the Shanghai Futures Exchange, silver is currently trading at 32,180 yuan per kilogram. That converts to approximately $144 per ounce, while New York is showing $118, creating a $26 premium for physical metal in Asia. $26. That's not a premium. That's a scream for supply. In a functioning market, arbitrage would close that gap in minutes, but the gap isn't closing. It's widening, expanding $3 to $6 per day as Asian buyers outbid Western sellers for every available ounce. This Shanghai premium is the smoking gun that proves the Western pricing mechanism has lost control. When Chinese and Indian buyers are willing to pay $26 more per ounce than New York prices, it means one thing. Physical metal isn't flowing west to east anymore because there isn't enough to flow. The vaults are being drained, refineries are backing up, and the paper promises traded on COMEX are becoming increasingly worthless as delivery requests go unfilled. Now, let's talk about what triggered this morning's apocalyptic sell-off, because understanding the catalysts reveals just how desperate the institutions have become. First, we had extreme leverage. Traders running 50x to 100x positions in futures contracts, chasing parabolic gains without understanding that leverage cuts both ways. When the initial dump started, it triggered cascading margin calls that forced automatic liquidations, turning a controlled descent into a freefall panic. Second, profit-taking was inevitable after the run we've had. Gold up 160% in 2 years. Silver up 380%. Those are generational moves that create massive incentives to lock in gains. Smart money started rotating out, taking chips off the table, which created the initial selling pressure that the manipulators exploited. Third, the broader equity market got slaughtered today. Microsoft cratered 11% after missing cloud revenue expectations and disappointing AI growth projections, which dragged the entire tech sector into the abyss. When Nasdaq dumps 4% and the S&P 500 bleeds 3%, risk assets across the board get liquidated as investors flee to cash and perceived safety. Fourth, technical indicators were screaming overbought conditions that historically precede corrections. Gold and silver had hit RSI levels not seen since the 1980 Hunt Brothers squeeze. Sentiment was euphoric, and positioning was extremely one-sided. Markets don't move in straight lines, and the flush was mathematically overdue. Fifth, there was no external catalyst, no Fed announcement, no geopolitical shock, no banking crisis headline. This was pure technical deleveraging, the market purging excess speculation and resetting for the next leg. All 5 of those factors are legitimate, all contributed to the violence, but here's what they're not telling you on CNBC. The fact that all 5 bearish catalysts hit simultaneously: maximum leverage, unwind, profit-taking, equity contagion, overbought flush, and technical capitulation, and silver still turned green the same day, tells you everything about the power of underlying physical demand. The institutions threw their entire playbook at this move: coordinated paper dumps, media fear campaigns, margin requirement increases, and algorithmic stop-loss hunting. They engineered perfect bearish confluence, and it lasted 6 hours before getting completely absorbed and reversed. Gold experienced similar chaos, dumping 2% in 47 minutes and erasing $3, $1 trillion from its market capitalization. Then it rallied 2%, and added $1, $9 trillion back within hours, behaving like a speculative altcoin rather than a 5,000-year store of value. When a $40 trillion asset class exhibits meme stock volatility, you're witnessing the death throes of a broken pricing system built on decades of paper leverage and fractional reserve bullion banking. And here's where it gets even more revealing. Nearly all the selling this week occurred during U.S. market hours. New York dumps paper derivatives while London coordinates, and then when Asian markets open, physical buying overwhelms the suppression and prices recover. That pattern, U.S. sells paper, Asia buys physical, has repeated every single day this week, and it's the tell that separates manipulation from genuine price discovery. The bullion banks, short hundreds of millions of ounces, are now so desperate that they have attempted 2 separate $15 raids on silver in 5 days. 2 coordinated attacks designed to break momentum, induce panic selling, and create the follow-through capitulation that would let them cover shorts at lower prices. And what do they have to show for their efforts? Silver back above $118 and the Shanghai Premium hitting new records. In the old playbook, 2011, 2013, 2020, a smash-down like this morning would trigger an avalanche of stop-losses and induce weeks of relentless selling. Silver's entire upside momentum could be short-circuited by a COMEX paper dump of a few billion notional ounces, scaring retail out and letting the banks cover shorts. That playbook is dead, cremated, buried 6 feet under, because the physical market has grown too powerful to manipulate with paper fiction. We spent 4 years, between 2020 and 2024, trapped in a $20 to $30 range, barely moving 50 cents per day. Now, silver is experiencing $15 intraday swings, behaving more like a tech stock than an industrial metal. The volatility is insane, unprecedented, and it's signaling that we're in a completely new regime where the rules that govern precious metals for 40 years no longer apply. Here's the critical detail. The physical supply chain is breaking in real time, in sequence, exactly as you'd expect in a genuine shortage. First, U.S. refineries locked up 2 weeks ago, backed up with metal and refusing new shipments because they can't process fast enough to meet demand. Then local coin shops across the country started halting purchases, unable to access capital or manage turnaround times as premiums exploded. Now, according to sources deep in the retail bullion industry, a major government mint is shutting down silver sales within the next 24 hours. First refineries, then coin shops, now sovereign mints. The entire distribution infrastructure is seizing up. And we haven't even reached the real squeeze yet, the moment when the derivative markets are forced to deliver physical metal they don't have. Let that sink in for a moment. We're watching the plumbing fail before the short squeeze even begins. This is just the prelude. The physical market starting to assert dominance over decades of paper manipulation. Now let's talk about what the big banks are suddenly saying publicly, because their about-face is stunning. JP Morgan released a note this week projecting gold could surge to $8,000 to $8,500 per ounce as private investors increase portfolio allocations from the current 3% to between 4%, 6%, and 6%. That capital flow represents hundreds of billions of dollars that haven't even entered the market yet. Check the progression of bank targets. 3 months ago, Goldman Sachs said $5,400. Last week, Deutsche Bank raised to $6,000. Yesterday, JP Morgan went to $8,500. The targets keep getting revised higher because the fundamentals keep getting stronger. The banks are finally acknowledging what independent analysts have been screaming for years. We're in a monetary regime change. The old price anchors are gone. The assumptions that governed precious metals, pricing since the 1971 Nixon shock, are being demolished by central bank buying, currency debasement, geopolitical fragmentation, and the failure of bonds to provide real returns. Gold hit $5,600 this month, amid safe haven demand and a shift away from long-term government bonds that are yielding negative real returns when adjusted for actual inflation. Now let me address the bearish case head-on, because I'm not going to pretend there's no risk in this environment. We just witnessed extreme volatility that can destroy leverage positions in minutes. $15 swings that don't care about your thesis or conviction. If you're trading on margin, holding paper contracts, running options or futures with tight stops, This market is a liquidation machine designed to separate you from your capital. Your long-term analysis doesn't matter when the margin clerk calls at 10 a.m. demanding cash you don't have. Your conviction is irrelevant when forced selling kicks in and positions get automatically closed before you even see the recovery. Over-leverage yourself in moves like this morning will wipe you out before the day ends, regardless of whether you were directionally correct. JP Morgan themselves noted that while momentum remains bullish, short-term profit-taking is inevitable, and we should expect more violent shakeouts. The higher prices climb, the more profit-taking opportunities exist for early buyers. The more leverage builds up on the way up, the more violent the deleveraging events become on the way down. Gold shows stronger liquidity and broader market participation than silver or Bitcoin, according to institutional analysis, which means silver, with its smaller market cap and thinner liquidity, could see even more extreme percentage moves both up and down. A 15% intraday swing in silver might correspond to a 7% move in gold. Leverage cuts both ways. And here's the other major risk. If equity markets continue selling off, if recession fears escalate, if we see genuine financial contagion, we could witness more forced selling in metals as investors scramble for cash and liquidity. The correlation between metals and equities during panic moments is real. It happened in September 2008 when gold fell 30%. It happened in March 2020 when silver crashed 40%. And it can absolutely happen again. Cash becomes king during liquidation events, and everything gets sold to meet margin calls and redemption requests. That's the risk for traders in over-leveraged positions. But here's why the bearish case doesn't change the structural setup for physical holders with a long-term view. Every single data point we've covered reinforces the bull thesis. Shanghai Premium $26 and widening, refineries locked up and refusing shipments, coin shops halting purchases due to capital constraints, major government mints shutting down sales within 24 hours, 2 $15 coordinated raids in 1 week, both completely absorbed and reversed within hours. The physical market is screaming deficit while the paper market is screaming manipulation, and the physical market is winning. The fact that silver turned green after a 15% crash in the same trading day is unprecedented in the entire history of commodity markets. That has never happened with silver, gold, oil, copper, or any other heavily traded commodity with a futures market. The institutions used to induce weeks of follow-through selling with a move like this morning. Now they can't even hold prices down for a full session because Asian demand, Indian demand, Chinese demand, it's relentless, overwhelming every paper dump the moment Western markets close. The Shanghai Premium, growing $3 to $6 per day, is mathematically unsustainable because arbitrage should close that gap instantly in a functioning market. That spread has to close, and it's going to close one of two ways. Either COMEX prices rise to meet Shanghai, or physical metal stops flowing west, and the entire COMEX LBMA pricing system loses global legitimacy as the reference for precious metals. We're already seeing early stages of that scenario with refineries backing up, coin shops exiting the market, and mints shutting down. The distribution plumbing is seizing up because demand is overwhelming the available supply. So where does this leave us heading into February? 3 critical takeaways, and then I'm out. Number 1, the old playbook where COMEX could dump paper and induce weeks of selling is officially dead and buried. Silver crashed $15 in 28 minutes and turned green the same day. That's never happened in market history. Physical demand from Asia is now powerful enough to overwhelm any paper manipulation attempt within hours, fundamentally changing the game. Number 2, the system is breaking in sequence exactly as you'd expect in a real supply shortage. First, refineries locked up, then local coin shops halted purchases. Now a major government mint is shutting down silver sales. This is the physical market seizing up because demand is overwhelming supply, and the Shanghai Premium is pulling metal east faster than the West can deliver. The real short squeeze hasn't even started yet. This is just the plumbing failing. Number 3, the major banks are revising targets higher in real time as they acknowledge the regime change. Goldman $5,400, Deutsche $6,000, JP Morgan $8,500 for gold. They're finally admitting what the physical market has been screaming. Private investor allocation increasing from 3% to 6% of portfolios represents a massive capital tsunami that's just beginning to build. And silver, with its tiny market cap and industrial deficit, is leveraged to that move. The unresolved tension that keeps me up at night is this. How long can the Shanghai Premium stay at $26 before the entire Western pricing system loses credibility? How many more $15 raids can the banks attempt before they realize they've lost control and start covering shorts regardless of price? And what happens when the physical squeeze we're seeing in the distribution plumbing actually hits the derivative markets and forces mass short covering among institutions holding hundreds of millions of ounces short? We're living through the transition from paper dominance to physical dominance in real time. The moves are going to be violent in both directions. The volatility is going to be extreme and psychologically punishing, but the structural direction is set. Do your own research, understand the risks completely, and never invest money you can't afford to lose. If you're trading on leverage, this environment will destroy you faster than you can process what's happening. If you're building a physical position with a multi-year view and you understand what's happening structurally, the currency debasement, the supply deficit, the Eastern demand, the derivative time bomb, this might just be the final shakeout before the real move begins. The institutions are done. The manipulation machine is broken. The physical market has taken control. And the squeeze is accelerating whether Wall Street acknowledges it or not. Invest with logic, never with hype. Question everything, verify independently, and understand that in this environment, survival is the first step to massive profits.